For more on how the SVB collapse is being felt throughout the tech industry and banking industry, we're joined by Solomon Partners CEO Marc Cooper. Marc, always great to get some time with you here. It's been a challenging few days, to say the very least. What are you hearing from clients at this moment?
We're hearing a lot of concern about the banking system. I was happy to see that the Fed jumped in and secured deposits because these are classic run on the bank issues that without confidence we could see a number of banks suffer. So putting the confidence back in the banking system that depositors aren't going to lose their hard-earned money is extraordinarily important. And so what happened here is a bank which technically wasn't insolvent became insolvent because of a complete imbalance between their assets and their liabilities. Short-term money that was a flight risk, and long-term investments that they had no access to.
Marc, this environment was already a tricky one for M&A, for what you do, right? Given rising interest rates, given uncertainty in the economy, what does this then do layered on top of that?
Good question. It's never good and for the immediate future, although you saw a very large transaction happen today, $42 billion transaction. But for the immediate future, it's gonna be a negative until people sort out what the future of the banking system looks like. Now, no one believes the banking system is in jeopardy, but there are certainly a number of banks out there. We've mentioned a few in your broadcast that are concerns to people. And again, not because they are fundamentally mismanaged or because, in fact, they are insolvent. This is nothing like 2008, where banks and investment banks were investing in securities that really, at the end of the day, had no value. Here, it's just a question of fear. It's a question of the classic run on the bank. And if you pull out short-term deposits, because again, banks borrow essentially short with deposits, and they lend long or invest long, either with loans or with buying government or other securities. So this is going to be a negative to the market. I would say credit would probably pull in a bit, although credit has been tough over the past number of months. Our view about M&A is it's sort of like there's a pending demand. Someone likened it to a car crash on a highway, and the cars are backed up, but eventually that crash will be moved, and then a lot of cars will go through. That's particularly the case for the private equity funds who are sitting on a number of businesses they want to monetize. They want to return capital to limited partners. And so I think we'll see it pick up. It also could have been, maybe I'm an optimist here, but could this be a deflationary event that causes the Fed to pause a bit? Part of the issue about M&A is having certainty on interest rates. And with the Fed continuing to raise interest rates, no one really has a sense of where it's going to end. So how do you price securities? How do you price companies? Having that stability, or at least the view of what will happen in the future, I think will start opening up the markets. And as you know, it's all about price. And right now, there's just simply a disconnect between buyer and seller.
Marc, does this also consolidate power in the financial services industry when it comes to deposit-taking banks? Do you and your companies that are your clients need to rethink who you're working with? Or, does this kind of remake the industry in that way as well?
It's unfortunately the case. I think you're right, Julie. I think the issue is people are gonna, as they always do in trying times, it's a flight to quality. So they're going to end up going to the biggest and most well-capitalized banks, which longer term is not a great thing for our banking system because we don't want to have too much concentration. And these banks do serve a purpose. Silicon Valley Bank served a great purpose for 40 years. Now, having said that, again, it has to do with the right kind of management. When you have $150 billion in deposits coming in a year and a half on top of an original balance of 50, and you don't keep a lot in liquidity, well, that's not a smart move. And so I think people have to be very cautious about where they're putting their money in. Having said all that, I hope this passes. I hope that confidence has been restored in the financial system. I hope people believe that they're not going to lose their deposits at the end of the day. And the bank system is about confidence too. And we're hoping that this passes. Are we at the first inning or are we at the eighth inning of this process? And the answer is I don't know. But generally speaking, what we've found in the past is they don't end quickly, right? These tough times don't end quickly.
Marc, given this situation, have you made any changes to how you think about running your own business?
Well, sure. I mean, as a steward for my partners and my investors, I do think about where our capital is. In fact, our capital is at First Republic, and we've not done anything about that other than monitor the situation. We feel comfortable that they have the adequate liquidity to support the business and support their depositors and their clients. And so, but you do think about these things, and we've seen clients who have moved their capital to other banks, other well-capitalized banks. I think to name First Republic, I think they made some of the right moves because it is about liquidity. One of the mistakes you could say about Silicon Valley Bank is should they have been more aggressive about bringing in equity capital earlier last week or weeks before that. And we often see, as we saw in the Lehman Brothers situation, is people don't really accept the fact that their stock could go to zero, and they don't accept the fact that getting life-saving capital preserves value. But as you saw in First Republic, while it wasn't equity capital, they have raised a considerable amount of liquidity in $70 billion on a $200 billion or so depository base. That seems like a fair amount of liquidity.
Marc, real quick before I let you go on First Republic, you're leaving your money there. You're not pulling it out.
I am. No.
Okay. All right. Solomon Partners CEO Marc Cooper, always good to see you. We'll talk to you soon.
Pleasure.